Risk management is the difference between trading as a temporary experiment and trading as a long-term profession. Yet it is the part most people understand last. New traders obsess over entries, indicators, strategies, and setups, believing that if they can just be right, more often everything else will fall into place. This belief is comforting, and it is wrong. In trading, being right is optional. Surviving is not. The golden rules of risk management exist to keep you in the game long enough for skill, experience, and probability to matter. The first and most fundamental rule is simple, but brutally honest. Never risk what you cannot afford to lose. This is not a motivational slogan. It is a structural requirement. Capital that is emotionally or financially irreplaceable creates pressure. Pressure distorts judgment. Distorted judgment leads to oversized positions, moved stops, and desperate decisions. Once that chain begins, losses compound, faster than learning. Professional traders design their risk so that any single loss is uncomfortable, but never threatening. Discomfort sharpens focus. Threat destroys discipline. The second golden rule is define risk before entering any trade. Risk is not what you hope will happen. It is what will happen if you are wrong. This means knowing in advance exactly where the trade thesis is invalidated and how much capital will be lost if that point is reached. Entering a trade without predefined risk is not confidence. It is denial. Markets reward preparation, not optimism. A trade planned with clear risk allows calm execution. A trade entered without, it becomes an emotional negotiation the moment price moves against you. Position sizing is the third rule, and it is where many strategies silently fail. A good setup with poor sizing is a bad trade. Risk should be expressed as a fixed percentage of total capital, not as a number of shares, contracts, or lots chosen emotionally. When risk as standardized outcomes become statistically manageable, when risk fluctuates with confidence or recent results, the account becomes vulnerable to drawdowns that erase weeks or months of progress in a few trades. Another golden rule is never add to a losing position. Averaging down feels logical, even brave, but it is usually an attempt to avoid admitting error. Adding to losers increases exposure precisely when information is turning against you. It transforms small planned losses into large unplanned ones. Professionals add to winners, not losers, and only when structure confirms strength. Losses are signals. Ignoring them is expensive. Closely related is the rule to respect stop losses without negotiation. A stop loss is not a suggestion. It is a contract with yourself, made before emotion enters the picture. Moving or removing stops after entry is one of the fastest ways to destroy consistency. Every time you break this rule and survive, you reinforce a dangerous habit. Markets eventually punish that habit severely. Traders who last treat stop-loss execution as automatic, not debatable. Risk management also requires understanding correlation. Multiple trades that appear diversified can be driven by the same underlying factor, such as market direction, sector exposure, or macro news. When correlated positions move together, total risk is far higher than it appears. One of the golden rules is to measure risk at the portfolio level, not just trade by trade. A series of small risks can combine into one large vulnerability if correlation is ignored. Another critical rule is limit daily and weekly losses. Trading is probabilistic, and losing streaks are inevitable. The danger is not losing. It is losing control during losses. Daily loss limits act as circuit breakers. They prevent emotional spirals where frustration turns into revenge trading. Stopping for the day after hitting a predefined loss limit is not weakness. It is professionalism. Tomorrow always offers more opportunity. Capital and clarity may not. Leverage deserves its own rule, use far less than what is available. Just because leverage is offered does not mean it should be used. Leverage compresses time and magnifies mistakes. Many traders mistake access to leverage for skill. Professionals view leverage as optional and potentially dangerous. They size positions so that leverage is a tool of efficiency, not a source of pressure. If leverage makes you nervous, you are using too much. Risk management is also about expectation alignment. No strategy wins all the time. Drawdowns are not signs of failure. They are features of the system. Traders who expect smooth equity curves panic at normal variance and abandon good processes. One of the golden rules is to design risk so that drawdowns remain within tolerable bounds, psychologically and financially. If a drawdown feels unbearable, the problem is not the strategy, it is the risk. Perhaps the most overlooked rule is protecting mental capital. Fatigue, stress, and emotional overload impair decision-making just as surely as financial loss. Trading when tired, angry, or distracted increases risk, even if position sizes remain unchanged. Professionals manage energy deliberately. They step away when clarity fades. Risk is not only what happens on the chart, it is also what happens in the mind. Taken together, these rules reveal a truth that beginners often resist. Risk management is not about limiting upside, but about making upside possible. Without risk, control profits are temporary. With it, even modest edges can compound over time. Risk management is not what you do after finding opportunity. It is what allows you to participate in opportunity at all. And once these golden rules are understood conceptually, the next challenge is practical learning, how to implement them consistently, how to design a personal risk framework that fits your temperament and strategy, and how to avoid the subtle ways traders rationalize breaking their own rules under pressure, which is exactly where we need to go next, by examining how to turn the golden rules of risk management into a system that actually holds up when pressure is highest, because rules that exist only in theory collapse the moment emotion enters the room. The first step is codifying risk into non-negotiable numbers. Decide in advance the maximum percentage of your account you will risk per trade, per day, and per week. These limits should be conservative enough that breaking them would feel obviously reckless. Once set, they are no longer decisions, they are constraints. The moment risk becomes a decision, again it becomes vulnerable to rationalization. The next step is embedding risk rules into your workflow, not keeping them in your head. Before every trade, a simple checklist should confirm position size, stop distance, total portfolio exposure, and correlation with existing positions. This takes minutes, but it prevents hours of damage. Professional traders do not trust memory or mood. They externalize discipline so that execution quality does not depend on how they feel that day. Position sizing should be calculated mechanically, not intuitively. Risk is defined first position size, second entry last. This sequence matters. Many traders reverse it, falling in love with an idea and then forcing size to fit emotion. When size is calculated from predefined risk, every trade becomes structurally survivable. This is what allows you to take the next trade with the same clarity as the previous one, regardless of outcome. Stop-loss execution must be treated as a binary event, not a discussion. Either the stop is hit or it is not. There is no just this once. If a stop is moved, the rule has already failed. Traders who last build an identity around respecting stops, not around avoiding losses. Losses are the cost of information. Ignoring that cost leads to ignorance with leverage. Risk management also requires portfolio-level awareness. Individual trades can be well managed, while the portfolio as a whole is dangerously exposed. Multiple positions aligned in the same direction, sector or macro theme, increase effective risk, even if each trade looks small on its own. A practical risk system tracks aggregate exposure and enforces caps on correlated risk. This prevents a single narrative from wiping out weeks of disciplined execution. Another critical component is drawdown response rules. Decide in advance what happens when your account is down a certain percentage from peak equity. This might mean reducing position size, trading fewer setups, or stopping entirely for a defined period. Drawdowns are inevitable. Chaos is optional. Traders who plan for drawdowns experience them as phases, not crises. Mental capital must be protected with the same seriousness as financial capital. This means recognizing early signs of emotional drift, impatience, irritation, tunnel vision, or the urge to make something happen. A robust risk system includes permission to stop. Walking away after a loss is not avoidance, it is risk management. Clarity is a resource. Once depleted, no strategy works. Finally, the system must be reviewed and reinforced regularly. Risk rules that are never tested against real behavior decay quietly. Weekly or monthly reviews should focus not on profits, but on rule adherence. Where did risk expand unintentionally? Where did emotion override structure? This feedback loop is where risk management matures from compliance into instinct. In the end, the golden rules of risk management only become powerful when they are transformed into habits that require minimal willpower. The market will always test you at moments when discipline is hardest. A well-designed risk system ensures that when those moments arrive, the damage is limited, the lesson is affordable, and the opportunity to continue remains intact. That is the true purpose of risk management, not to eliminate loss, but to make learning sustainable. If this continuation helped you see risk management as a system rather than a set of warnings, consider subscribing to stay with these long-form discussions focused on building durability in trading, and leave a comment sharing which risk rule you find hardest to follow in practice, because the rule you struggle with most is usually the one that protects you the most when it finally becomes automatic.